All right. So good morning, everyone, and thank you for joining us for the WT Financial Group Investor Webinar. Today, I'm joined by our CEO and founder, Keith Cullen. Keith, I'm going to jump into it, and if you've got questions at the end, please use the Q&A function, which can be found at the bottom of the screen.
Terrific. Thanks, Jane. Thanks, everybody, for joining us. All right, Jane, you're handing straight to me, are you? Let's get into it then. Ladies and gentlemen, appreciate this opportunity to take you through our indicative half-year results, which we released to the market yesterday. I think they're probably best read for those of you new to the company in conjunction with our latest annual report and probably our presentation from the full year that we did in September last year. But Jane, let's get into it. We'll start with the disclaimer on the next page, please. I think everybody has probably seen one of these before. But just to say, these are our indicative results we're going with today. We'll also talk about some forward-looking statements. So general advice only, and undue reliance should not be placed on any forward-looking statements. Thanks very much indeed, Jane. We'll move forward to the next page. All right, for those of you new to the company, I'll just give a quick background on what exactly it is that we do and how the company is structured. WT Financial Group Limited, these are our brands and the services we provide. So WT is the listed parent company, and it has a number of wholly owned subsidiaries, and the company is broken into really two divisions. Our B2B division, which is providing services to businesses, and a B2C division that is providing some services directly to consumers. And I'll probably start from the bottom up there because that's the background of our company and where all of our experience lies, as we, all of the executive team and employees within the business have a great deal of experience in providing financial advice, insurance advice, mortgage broking, accounting services, etc., a broad range of financial services direct to consumers. We have a great deal of experience in recruiting and training advisors that we gained through building that business, and also recruiting clients, advertising and marketing and so on. And that's really what led us into our B2B space, which is providing licensing solutions for advice practices. And we have built that business through acquisitions, starting with our original acquisition back in 2018 of an advice network called Wealth Today. We followed that up in 2020 with the acquisition of Sentry Group, 2022 with the acquisition of Synchron, and then late in 2023 with the acquisition of Millennium 3. So that has seen us emerge as one of the largest networks in the country. We have around close to 400 advice practices in the country that are operating under one or the other of our licenses, and literally hundreds and hundreds of advisors in the network. And for them, if we flick onto the next page, Jane, whilst we've got those four businesses and we've retained those B2B brand names, because there's a great deal of sort of legacy sitting and value sitting within those brand names from a B2B perspective. So we've wanted to retain those brand names, which we've done. They're really B2B brand names, though. The consumers of the advice practices, or the clients of the advice practices that are sitting under our licenses, it's not that those brands are hidden from them, but really they see themselves as dealing with the local business. Might be Mary Smith and Associates, or Adelaide Home Loans and Financial Advice, etc. We're helping our practices underneath those licenses of ours build their own brands and build their own connection with their local communities. So what services are we providing? Well, to start with, we're licensing the practices and therefore licensing the advisors. All financial advisors in Australia need to be attached to an Australian financial services license. They can go and get one themselves. Some practices do that, but most of them see the value of being involved in a business that can provide a really broad range of resources to them, many of which they only need from time to time. So, it's not efficient for them to be running their own license in many circumstances. So the practices that sit in our group, we put together their approved product list for them, which is we enter into relationships with the superannuation funds, the fund managers, the insurance companies that enable our advisors to access and use the services and the products of those product providers. We create a full policy suite that helps the practices stay up to date with what the latest laws and regulations are and what the latest regulatory guidance is from the regulators. We provide our advisors ongoing advisor education and training. And whilst our advisors all have a statutory requirement to do a certain number of CPD points, continuous professional development points each year, our focus is really more than CPD points. It's really helping them become better practitioners and helping them build their practices as well. We provide them a range of consumer engagement and marketing tools. We're responsible for organising the professional insurance cover, professional indemnity insurance cover for them. We collect all of their remuneration for them. So we manage the flow of remuneration through the system, and a risk management framework helping them manage the many inherent risks in financial advising. And really our focus is on helping them manage the risk to client and manage the risk to the advisor themselves. We also provide a range of estate planning services. We have our own law firm that helps our advisors deliver estate planning services, which there's certainly growing demand for when it comes to wealth and personal insurance advice clients. So whilst we've maintained those 4 brand names, we have brought all of the services together under our centralised advisor support and services hub called Wealth Advisor. So it's not like we're providing 4 sets of all of these things. We've really brought these businesses together and rationalised them under a common centralised hub. And importantly, that's enabling us to really provide the full range of services across all 4 of those cohorts, and to do so in a really efficient manner. As WT Financial Group, we also assist our practices with advisor recruitment and their practice management and support, helping them get more efficient in the delivery of services to their clients and build better, more profitable businesses. And also, we've always provided them with M&A support, merger and acquisition support, and succession planning, but I'll talk more about this later. We're really seeing considerable increased demand for assistance. Our practice is looking for assistance with that succession planning and also M&A. I've talked already about our direct-to-consumer business, which is, this is much more smaller scale than what it was when we made the decision to move into the advice network space back in 2017-18, as we sold off a lot of the assets of Spring Financial Group. But we do maintain it as an operating practice, providing B2C financial advice and tax and accounting services, and also estate planning services. Of course, I mentioned earlier, we do that ourselves through to retail clients. And we really call this our R&D lab. For us, it enables us to make sure that we're not losing touch with what it's like to run a practice and sit in front of clients every day. All right, Jane, terrific. Thank you. If we could move on to the next slide. Really pleased with these indicative results that we've put out for the first half of financial year 2025. And so you'll see us, we're expecting to report around a 33.5% increase in revenue and other income across or in comparison to the prior corresponding period, and about a 35.8% increase in net underlying profit. So we've seen revenue up, we've seen our gross profit margin up, we've seen our EBITDA up, the underlying EBIT up nearly 20%, and then the underlying net profit before tax up 35%. So that's what the underlying business looks like. Statutory P&L adjustments, we report these now below that underlying business line. No one-off adjustments for this period, whereas in the prior corresponding period, we had sold a retail mortgage book. That was that $527,000 worth of profit we booked on the sale of that mortgage book. And we had some one-off expenses of $75,000 that we expensed associated with, was either that sale or that maybe it was legal fees associated with the purchase of Millennium 3 that happened during that period. So on a statutory basis, as we had a net, whatever that works out to be, 400 and something thousand dollar positive impact on the statutory net profit before tax in the last period. I haven't included the tax calculation because it hasn't been finalised yet. Regardless of where the tax lands, we're in the fortunate position of having a franking credit balance, but also having some accumulated losses from when we did some significant restructuring a few years ago. So regardless of where the tax position would land, obviously, there'd be no tax payable at a half year at any rate, but for the full year as well, as we don't see that we'll have any cash tax liability arising because of those carried forward losses. That may not be the case next year, but certainly be the case for this year, and that will enable us to access those franking credits still, and any dividends for a little while will be fully franked. All right, Jane, we move through the next slide. Summary there of those. Really, this was for the release that we're putting out of this today. I've gone through those first few bullet points there. I guess the most pleasing part is that the underlying business net profit before tax up around 35% to 2.45 million. Cash and cash equivalents at 31 December, a bit over $7 million. They were about 5.3 at the 31st of December 2023. And that $7 million is net of some cash payments that we had out during the period, which was 1.46 of cash out the door on fully franked dividends during that period, and a little bit over $1 million went out early in the period, which was related to a prior acquisition. And I put that there just to really note that with all of the acquisitions that we made along the way, I think with the exception of Millennium 3, as the other three acquisitions we'd done had a mix of upfront and then deferred and upside payments associated with them. So with a number of those acquisitions, those payments were staggered up to sort of 2.5 years. What I can say to you is there's no further obligations with respect to any of our acquisitions. So that $1 million that went out the door in July was the last of those. Board anticipates a fully franked interim dividend of 0.2 cents a share. That'll bring our declared dividends for the 12 months up to 0.7 cents, which I think is a pretty good fully franked return. Okay, next slide, please, Jane. I've included this slide, which we had in our full year results deck that we presented back in September, just to remind people the sort of trajectory that the business has been on. So I haven't taken into account the half year on these, but I just wanted to remind those that have been following the company for some time, the sort of trajectory that we've been on, and also for those that are new to looking at the company, for them to understand what we've managed to achieve through this restructuring and M&A activity over this period of time. So we've delivered 4 consecutive years of revenue and profit growth, executing that acquisition and renovation strategy, and really, I guess we call it redefining the advisor-licensee relationship and rationalising our operations and our networks along the way. So it's really been 4 straight years of compounding growth for the underlying period. We returned to paying dividends I think we paid that first dividend in a long while back in October, and we're on a path for twice yearly dividends, obviously subject to profits and cash flow, and we're pleased to be able to be indicating that we'll meet that this year with this interim dividend. Next slide, please, Jane. And there's just a little bit about the balance sheet across that same period of time. Again, for those that are new to the company, is over that 4-year period, the last 4 financial years, as net assets have increased by close to 400% from FY21 to 24, against an increase in issued capital of just 68%. Assumed liabilities and back-end payments related to all acquisitions have now been satisfied, as I mentioned, and our corporate debt is at a very manageable 6.7%. So pretty happy with the shape of the balance sheet as well. Those of you that are new to the company, again, if you take a dive into our last annual report, that will give you some more detail around the balance sheet. Thanks, Jane. If we move on to the next slide. So look, I've been really bullish on the sector for quite a while, and I understand why some people haven't been in the wake of the Royal Commission, but just to sort of recap, our industry, the reason we're so excited about it, or our profession, there are incredible tailwinds and a real supply-demand imbalance that has emerged, and we think provide a significant upside. Not just, look, our performance, I think, and our outlook is not just reflective of our company and the performance of our team and our network, but we think it's very positive for all advice practices and also for all advice network operators. The fundamentals are pretty straightforward. Advisor numbers have declined in Australia to a little more than 15,000 since the Royal Commission back in 2017-18. That's a big drop. And there's no way that natural inflow is going to go anywhere near matching the natural outflow from people retiring over the next few years. We're seeing only around 400 or 500 financial advice graduates coming out of universities at the moment. So we don't see there being any immediate outlook for a change in the supply side. And so whilst we've seen this incredible decline in financial advisor numbers occurring, the number of consumers in core constituents that are seeking advice and their capacity to pay just continues to grow. I just put one little snippet there. If you have a look, between the last two census, the retiree market was up 19%. That's that 65 plus market. Now that's against a growth in population across the same period of a little bit over 8%. So we've got this aging population, and at the same time, the core pool of the asset pool, which is superannuation that consumers are seeking advice on, it's on this relentless statutory mandated growth trend. I think we're pushing about $2.5 billion of net growth in superannuation assets now, may even be a bit higher than that. We've got, and that net growth is statutory and voluntary contributions to super, less drawdowns from super from people that are in pension mode and are drawing down out of their super or taking lump sums out, plus the asset growth, well exceeding $2 billion each and every week. So it's been an interesting thing that's happened with financial advice over the last sort of 5 years or so, and that is really it's continued to move from what used to be a mass market industrial model, and it's been replaced by a much narrower professional services model, with advisors now able to generate more revenue dealing with less clients. There's considerable upside that remains in that, I think, is there's still a lot of advisors out there that have got room to adjust their pricing upwards based on where we're sitting from a supply demand perspective, and certainly relevant to the amount of value that they're adding to clients. So strategically ourselves, as we're going to continue to drive paradigm shifts in the licensee advisor relationship to really help practitioners improve outcomes for themselves, their clients, and of course our shareholders. And if we flick onto the next slide, Jane, I'll talk some more over the next couple of slides about what those are going to look like. Broadly speaking, I think we're seeing a wealth management boom in Australia, and it's continuing. Rapidly expanding market it is, backed up by that mandatory superannuation that I've talked about, and demographic tailwinds that are seeing a wall of people and a wall of capital nearing retirement. And to put it in perspective, Australia's pension pool, or its superannuation pool, is the 5th largest globally. There's over $4 trillion in super assets now. The reason I keep talking about superannuation is if we looked at all of the advised money and clients in our network, so I'd say to you around 70% of the advised money in the network would be advice around superannuation assets. There's two reasons for that. It's obviously a big pool of capital, but also since the introduction of compulsory superannuation and the tax advantages associated with using it as a saving and investing tool, people have pushed a lot of voluntary contributions into super as well. So, you know, for a lot of people, gone are the days of having a stockbroker and a set of direct investments outside of super. Most people, particularly once they get into their 40s and 50s, once they're heading towards retirement, are really sensibly pushing their assets into superannuation if they don't need to access them. So a lot of assets that might have been held directly 10, 15, 20 years ago are really driving that superannuation pool as well. It's not just the mandatory contributions. Either way, there's a steady inflow of funds, and really it's baked in growth for the profession, which is why we say we're seeing a wealth management boom. We've got that aging population that I talked about before. That's increasing demand for financial advice. Latest estimates are there's around 3 million Australians that will become eligible to draw from their super in the next 10 years. So that's 300,000 new clients a year that are getting eligible to draw out of their super, and there's going to be at least $750 billion of funds shifting from accumulation phase to retirement phase. So why this is important is it's really in that run up to retirement. A lot of people are seeking advice that are younger, in their 20s and 30s is pretty rare, but certainly smart accumulators and wealth creators are seeking advice in their late 30s through to their 40s. But those that haven't, it really comes into focus as they get close to retirement. And that is where there's an enormous amount of demand that's coming into play now. So as more superannuation members are getting close to and hitting that retirement phase, they're needing advice more frequently on more complex issues. And that's when they need the help of a financial advisor. Most of them are seeking holistic advice, so they're not just looking for advice around the super. To give them proper advice about what they should be doing with their super, advisors need to really look at what their circumstances are more broadly as well, how their assets are structured, and their cash flow is structured outside of superannuation. So this is where advisors come to the fore and can have an enormous impact. And I often get asked, what's the ideal client look like? It's not necessarily that advisors are looking to deal with high net worths or ultra high net worths, although we certainly have plenty of those within the very significant client base that our advisors deal with. Really, a lot of, the average consumer now, with the right advice on how to structure themselves in the run up to retirement and at retirement, the right advice can have a very material impact, even when we're only talking about smaller balances. So the result of all these tailwinds and the boom that's going on is there is a significant unmet demand for advice. It's really giving pricing power to quality advice firms. Next slide, please, Jane. That's very important to us before I duck into this, is why does it matter that our advisors' revenue is going up? Well, this is not the same with all advice network operators, but how we earn our fees and make our profit is the services we're providing our advice network, our practices in the group, is made up of a number of both fixed and variable components. So with all of our practices, we are charging them a fixed fee relevant to their practice, and then normally a per advisor fee. And then we're sharing in the revenue and therefore sharing in the upside with them, which is where we're always motivated to help them get more efficient about running their businesses and make sure that they're maximising their revenue opportunities. So we've got that blend of both fixed and variable fees. So there's really some forces driving industry consolidation at the moment. We've seen a lot of industry consolidation, obviously, across advice networks across the last 5 years. We've seen the banks and AMP and the insurers sort of exiting the advice network space in the wake of the Royal Commission. And then we've seen a lot of M&A activity in our space. I've mentioned already the 4 acquisitions, the businesses that we've put together since the Royal Commission in 2017-18. There's been a lot of other activity going on, and that's really been what's been driving that has been it's getting increasingly complex to provide advice, and the services that practitioners are requiring out of their advice network operators is increasing. So you need scale to be able to do that and do that properly. The days, those of you that are online that know the financial services sector, brokers and others that have been around the wealth management space will be familiar with the old concept of sort of renting a license, operating under someone's AFSL, and then the AFSL not really doing much for that other than providing the licensing. Those days are long gone behind us for smart practices. They're really looking for a very broad range of services and support, and they're also wanting to make sure that the risks that are inherent in providing advice are properly managed within their business. So to do that and do it well, you absolutely need to have scale in the business, which is what we've been able to achieve through our acquisitions and through bringing everything together under that centralised support hub that I mentioned before. What we're seeing increasingly now too, though, is significant M&A activity in the underlying practices. And the regulatory complexity and the chokehold on the supply of human resources has really started to favour larger, well-capitalised firms that can leverage those resources. With that, what has restricted the supply of advisors and will continue to do for a considerable amount of time, we see, and I'll talk more on this issue as we move on, what constitutes a relevant degree to become a financial advisor was cast by the previous government to be a very narrow set of degrees. So, if I look at the number of people that were graduating courses like commerce and economics and finance and accounting last year, we're talking about tens and tens of thousands of people. Out of those, there was only about 500 that came out of university with what's called a relevant degree that would put them in a position to be able to start a professional year. So that's nowhere near enough. So there's real demand for human resources, and that's meaning that firms to grow are really needing to acquire advisors, if you like, and that's driving a lot of M&A activity. Obviously, scale efficiencies in technology, administration, marketing, and risk management are key competitive advantages for practices. This is seeing smaller practices increasingly joining or selling to larger practices to maximise those outcomes. So as demand continues to grow and as the number of advisors has plummeted and, let's say we're stabilising, we're staying at around this 15,000 mark at the moment, to grow a business, you're going to need to be spending more time sitting in front of more clients. So I'd say to you that over the last 10 years, as we moved out of this mass market model, the average advisor in Australia used to be dealing with, maybe 200, 250 clients on average. That number's dropped to around 120 on average. Practices that come together with others so that they can operate a really efficient set of processes and get scale advantages are freeing up more time for their advisors to do less administrative work and more client-facing work that we're hoping, particularly with the advent of new technology solutions that are coming into the market, to see that number 120 go back up towards 150, 180, 200. And so we're seeing that we're going to help our practices drive significant growth through becoming more efficient. There's big demand out there for practices. Private equity firms from all around the world are targeting Australian advice practices and also wealth management more generally. We're seeing global players hitting Australia because they're seeing it as stable, high growth, and they're seeing an opportunity for valuations that are at a discount to what they would need to pay internationally. So that's attracting a lot of interest globally. Recent deals are really emphasising the attractive valuations in the mid-market advice sector here in Australia. And this is twofold. As global operators are coming into the Australian market, they're looking at valuations here, bidding up the value of practices, which is fantastic. Valuations we're seeing at the moment are definitely on an upward trend, but they're still well below what these global players would need to pay if they were playing in their local markets. So we see that there's going to be considerable more attention paid to the Australian advice market, and obviously as one of the largest network operators in the country, we're very enthusiastic about that trend. Next slide, please, Jane. Why invest in the Australian market? Great recurring revenue models from ongoing client fees. So advice practices and us as a network operator benefit from those ongoing fees with clients. Certainly there's a reasonable amount of upfront revenue in the market when advisors are dealing with clients for the first time. But predominantly the value is sitting in the ongoing relationship with clients paying ongoing fees to advisors for ongoing advice. There's also ongoing commissions associated with personal insurance products, life insurance and total and permanent disability and income protection and so on. So we've got these recurring revenue models, in many cases linked to asset value. So, you've got not just the ongoing fees, but you've kind of got that baked in growth from the value of the assets growing, and also those with superannuation, there being that baked in statutory growth from statutory contributions and voluntary contributions as well, of course. So we think strong industry fundamentals that are underpinned by that superannuation growth that's fueled by statutory contributions. Obviously, the contributions go up with wages growth as well. We're seeing attractive valuations to the global peers, and that's attracting capital into the market. So we think there's significant opportunity for advice practices to scale swiftly with M&A in what remains a relatively fragmented market. So if we flick on to the next slide, please, Jane. Why WT? Well, we think we're in a unique position strategically. We have got a proven track record of success in M&A with a model that's been fine-tuned for scale in an increasingly consolidating market. We've kept this multi-brand strategy serving a really broad advisor and client base, but we're doing so from a centralised support hub that provides efficiency in service delivery and, of course, consistency of outcomes in our dealings with our advisors. We've got a proven track record of integrating those acquisitions and driving the synergies. Focus on mid-market acquisitions with attractive returns. We've done that. We're getting great return on capital. And look, when opportunities present, we're positioned to further scale if they do. Now, what I'd say is this: we're helping our practices grow, and we're really motivated to help our practices grow because we've got that revenue share arrangement with them. So we've got perfect alignment with them. And we're increasingly working with our practices to further modernise their businesses through both technology and corporatisation initiatives. Some of this stuff that's happening with AI is absolutely fantastic for the advice profession. Not so much in terms of giving advice to consumers, although we think opportunities open up there, but most definitely in terms of giving practitioners more time to sit in front of clients through doing an incredible amount of work, recording meetings like this that they're having with clients, producing file notes, producing follow-up materials for the clients. It's incredible what some of this AI is doing in terms of making more time available for practitioners, which we're certainly helping them with. And that will help them achieve more face time with clients as this supply-demand imbalance prevails. What we're seeing also is increased demand from practices, both within our network and also external to the network, for support and advice around facilitating M&A activity, including our practices are looking to us to help them access debt and also equity markets and support with their legal and due diligence programs. We're very well positioned to play a key role in that, with considerable experience both at a board level and corporately and at an executive level in our business with M&A activity. So we think we're really well positioned to play a key role and respond to that demand that we're seeing out of our practices. And this presents exciting new revenue and profit opportunities for the business. Jane, if we flick onto the next slide. In conclusion, WTL's positioned well for growth, but what I'd say to you is we think now is a time to consider investing in or increasing exposure, not just to WTL, but also to the sector, so that you can share in this upside. From WTL's perspective, we're well positioned to harness the growth and consolidation. I think we've shown consistently over the last 4 or 5 years now that we've been able to really do that through M&A momentum, where we think it's set to continue. Demand for advice continues rising. Supply of advisors is constrained. Pretty basic fundamentals. And now I think a strong track record proven out of the executive team here at WTL on delivering upon what we set out to do when we embarked on this sort of transition to be B to B focused back in 2018. Jane, I think we've got a couple more slides here. I won't bore people with the details of them, but we did want to include them. Those of you that don't know us, is really brief bios on the board. And then next page, Jane, leading executives as well. What I can say to you is a really well-rounded out and broad range of executives there. If you hop onto our website as well, WT Financial Group or WTFGlimited.com, you'll see a full depth of the management team there as well, going down and including really all of our senior management across the country, including our team of regional managers. So I'd encourage you to have a look at that. Whether you're new to the company or whether you've been following the company for a while, please go and have a look, and you'll see that we've assembled a bloody good team with a heck of a lot of experience that our network can really benefit from. Next slide, please, Jane. Final one there. I just thought it's worth saying before we wrap up. founder-led business with backing of some really experienced institutional investors that understand the financial advice space. So, board and shareholders sitting, board and management sitting at around 30% of the business. So that our interests are aligned with your interests as shareholders or potential shareholders, and backing from a really good range of long-term investors in the business that have backed our vision. Thanks very much indeed. That wraps it up, and we'll move into Q&A. And I know, Jane, if you're there, as I'd had a couple sent directly to me that I flicked through to you, and I think you'd received some others as well. But obviously, we'll open up the Q&A as well, Q&A chat function.
Yeah, absolutely. And again, if you do have questions for Keith, please use the Q&A function, which can be found at the bottom of your screen. But let me kick these off. So, and Keith, you touched on this in your presentation, but so with the increased M&A and larger scale advice firms emerging, do you see a future for individual sole practitioners?
Yeah, look, absolutely, Jane. There's no question. And look, my daughter might end up being one of those. She's sort of just getting towards the end of high school now and thinking about what she's going to do at university. I'd certainly encourage her to move into the space, and there's no reason that a bright youngster coming out of school, I'd be happy to encourage them to hang a shingle out and start their own business. And so, and then look, there's a lot of people that are quite happy working by themselves. It's interesting when we talk about single advisor practices, though. I wouldn't have the view when somebody talks about a single advisor practice of someone sort of working in their kitchen at home by themselves. A lot of single advisor practices are actually a practitioner inside a multidisciplinary business, mortgage broking and/or accounting practice, etc. So we see quite a bit of that. The advisors that we have in our group, whilst there's only one advisor, they're not a one-man band. They've got a partner or two or three or four who are accountants and/or mortgage brokers, and then they've got a support team around them as well. So whilst it might present as a single advisor practice, as you might be talking about a business with half a dozen or a dozen people in it still. So there's absolutely a future for that. No questions at all. And many people, and look, we love supporting single advice practices. We're one of the few licensees, I think, left about that has actually got a model and will support startups. And I'd say to you, we've got a number of startups in the group that have started with us just in the last 12 months or so that maybe have left a salaried position or somewhere. So we don't discourage that at all. But those that are looking to maximize their asset value, and certainly the ones that are looking towards retirement, that might be in their 50s, even heading towards their late 50s or early 60s now, that might have been a single practitioner, they're going, well, how am I going to maximize my asset value and my outcome for when I am ready to exit? And there's certainly a great deal of options for them to do that and maximize their outcome by coming into a larger practice. We've got a few we're working with at the moment, 4 advisors that just spring to mind at the moment, all looking at coming together to form one larger business. 3 of them are looking to retire as early as 2 years and as late as 7 years. And they're saying, gee, well, in that next 2, 3, 4, 5, 6, 7 years, if I stay as a single advisor practice, or a couple of them are actually multi-advisor practices that they'll be coming together to create something much bigger. If we stay in the smaller framework we're in now, I'm doing everything. I'm running my administration, I'm running my marketing, I'm running my tech strategy, I'm spending time doing that. If we come together into a bigger structure, it's the same amount of effort to do that across a much bigger business and the same amount of staffing to do it across much bigger businesses, what it is to do it across 4 smaller businesses. And these practitioners are going, wow, that'll give us an incredible amount of time to make rain and sit with more clients and sign new clients up and really maximize the value of our asset over the next sort of 2, 3, 4, 5, 6 years, depending upon when they're ready to retire. So I'll just stay on that point because there's a question popped up in the Q&A there of our licensed practices. How many single advisor practices are there? Look, I'm telling you, I think we've got about 520 personal advice advisors and about another 40 or 50 odd general advice advisors in the network, and I'm not exactly sure what the practice number is, whether I think it's less than 400, not much less than it. So that'll tell you there's particularly, look, most of those GA advisors, the general advice advisors, are single advisor practices, so that accounts for them. Look, it's probably around half of the practices, I'd say. But again, don't think about them as one-man bands. I'd think about them as probably sitting inside a bigger business.
Thank you, Keith. You're right. There's quite a few questions coming through, so I'll get through them. Next one. So do you foresee further consolidation coming in at a licensing level?
Look, I probably do. It's certainly acquisition is not a key strategy of ours now. We've achieved the right sort of scale that we need to underwrite all of the critical supports that we think practices are demanding. So I won't say no to acquisition opportunities. I think there's a number of subscale operators out there that are really, probably going to look to consolidate either amongst themselves or into larger groups. But it's not driving us. Neither of it. Look, we'd love more advisors, don't get me wrong. And we love hanging on to advisors, but it's not the core driver for us now. Our focus is on making sure we're helping practices become more profitable and drive their own revenue and build their own asset base. And in doing so, that's why we love being so closely aligned with them, with the way that our arrangements are structured with them, is we're all on the same page as achieving that outcome. If we help them become bigger, better, stronger, is we become bigger, better, stronger, and more profitable for our shareholders as well.
Thank you, Keith. So next one, the Minister for Financial Services has quit the government with no replacement due before the election. So in your opinion, does this end the chances for further reforms?
Oh, look, there's one key reform that we need in this profession, and that is so that we can all get back to growing and actually growing the profession. And that's a change to what constitutes a relevant degree. And look, I think we'll see that regardless of who makes government next. I don't think we'll see any further legislative changes before this election, though. So the answer might be in the immediate future, it probably does see an end to it.
Thank you for that, Keith. Okay, next one. So do you see the supply side of advice changing in the future?
Well, no time soon because of that relevant degree issue. But I tell you, I say to anyone that will listen, and we've been saying it for years, it needs to be fixed, is when kids come out of high school, they're not ready to make a decision about doing such a narrowly cast degree as a financial advice degree or a financial planning degree. They're thinking about doing finance, economics, commerce, business and law, what we thought a relevant degree was going to mean. And we've got to get back to that. Kids, last year, I think there was something like 30,000 commerce graduates. Our practices would love to be able to recruit those commerce graduates, put them straight into a professional year, give them some relevant vocational training around the specifics of advice, and get them sitting in front of clients. We need to get back to that, and I think we will within the next few years. And that'll be great because it presents new opportunities then to actually grow the profession. And let's hope so, but I don't see it changing immediately. Certainly not in the next couple of years.
Thank you, Keith. There's a compliment here. So the growth's been impressive, but how do you see that being sustained?
Well, I think it'll be a different style of growth, Jane, as I think, I've talked today about the emerging revenue opportunities that, our practice is seeking advice from us around assistance with their M&A and around helping them access debt and capital markets and providing them with, advice around bringing themselves together with other practices. And we're seeing that demand from outside the group as well. And obviously there's that opportunity for us to keep driving the revenue lines of the practices, which in and of itself sees us growing. So a different type of growth, but that's where our focus is in continuing to improve not just the quantity of the outcomes, but the quality of the outcomes.
All right. So next one, your PE has been below 8 times until recently. and it's still only around 10 or 11 times prior year earnings. So, what accounts for this, and why do you think that will change?
Our PE, Jane, did you say?
Mm. Yeah.
Yeah, look, uh, I think we've just got, we're pushing perhaps close to 12 times prior year earnings now, but it's true, is that, it was very frustrating for us with it trailing down around sort of 8 times or, less than 6 times EBIT for a long period of time there. I think we're seeing the market start to respond now. I'd reflect, why is our own PE been down there? Look, in fairness, we moved into the advice network space through a relatively modest acquisition back in 2018, and people have seen us make subsequent acquisitions, and they've probably gone, "Sounds great, Keith. Let's see how you go." Big execution risk associated with such a bold acquisition strategy as we've embarked on. I reckon now we've proven that we've been able to execute on it. If you look at the last 4 years and the consistent growth, and so I'd say that people are now saying, well, I think execution risk always, day-to-day management risk is always there, but I think the execution risk around the acquisition strategy is gone. And I think as we've got back to paying dividends, people have said, well, let's start to mark WTL up on the basis of that track record that we've seen emerging and that risk having gone. I think if you look at us against our peers, I think Morningstar tells us that the sector's trading at about 13 and a half, and I would have thought, given our growth profile, we deserve to be above that. So I think we can only keep doing what we're doing, which is delivering, and hope that people wake up to the upside, not just with us, but in the market generally, that clearly this global capital's awake to. So let's not give all of the upside to the global capital, and let's keep encouraging Australian investors to look more closely at not just us, but the sector more generally.
Thank you, Keith. Okay, next one. So, what are the longer term risks to capital in the sector?
Yeah, really good question, Jane. Look, there's always the regulatory risk in a highly regulated market like this. But I think we've been through a tumultuous period going back to the future of financial advice reforms in 2012 and the life insurance framework review and then the Royal Commission. I think if anything, we're going to see the regulatory burden released rather than it make things more difficult. Certainly both sides of government have been talking about that, if you can take them at face value. So I think that risk is less than what it might otherwise be in a heavily regulated profession or industry like ours. And I think I don't see any brave government meddling with compulsory superannuation, statutory contributions and so on anytime soon. And the meddling that they do around superannuation just makes people need advice. We wish they'd leave it alone, frankly, but the more complicated they make it on consumers with changes to tax and contribution rates and so on, the more people need advice. So I'd say probably the biggest risk to capital would be that exactly what the attraction to capital is at the moment, which is the supply-demand imbalance. In the longer term, we definitely need to get that supply side fixed. Otherwise we'll go forward 10 years' time and there'll be no one to sit in front of bloody clients. The business, it'll be like having a legal profession that only included, King's Counsel. That's what it'll look like. It will get fixed. I feel very confident of it, and that'll again let us ride this wave of supply-demand imbalance, and then a new wave really expanding the profession over the following period as it does get fixed. But that'd be the number one risk.
Thanks, Keith. Okay, we've got another one that's just come up and took a little bit more time. So, how do you see AI changing the provision of advisor services, and what activities are you undertaking to leverage the opportunities provided by AI?
Yeah, look, it's really exciting. We run a lot of advisor groups and a lot of advisor education and training for our advisors. So we're always talking to them about this. But we also run, our regional managers get together the principals of all of their practices in smaller groups that we call our optimum peer groups on a really regular basis. And I love the few of those meetings I've dropped into, and the feedback I get back from the regional managers is incredible. An amazing amount of innovation going on. We've got so many of our practices are trying so many different things. I'd say to you that the most consistent theme we're seeing is really in helping on the administrative side. And that's just things like recording meetings. I have meetings online with a number of our advisors, obviously, and increasingly they're within 5 minutes of the meeting being over as they're shooting me back a set of file notes and a summary of follow-up points and action items from the meeting. That sort of technology is incredibly valuable in the advice space when you think about it's your face-to-face meetings with your clients and the following up on the action items, both in terms of managing the workflow inside the business with your team that's supporting the clients, and also with the clients themselves. Gone are the days of smart advisors spending 2 hours before they go home at night with the yellow pad writing out all of their file notes to put into the file and to hand out to their admin team to execute on implementation stuff the following day. It's all done within a minute or two of the meeting being over. And that's presenting incredible opportunity for the advisors that are already working too hard. It's giving them some time to spend with their family and recharge their batteries. For those that are wanting to keep driving and building their asset value, it's giving them more face time with clients. And I'd say it's that type of tech in the business managing workflows and file structures that is really delivering the best value for now. And certainly ourselves, we're investing heavily in it to help us in the risk management framework, getting more efficient and more consistent outcomes there as well. So, and goodness knows where it's going to go.
Okay, Keith, running out of time, but finally, what should investors look forward to over the next 3 to 6 months from a news flow perspective?
Well, I mean, I think, keep an eye out obviously for the full year results and keep an eye out for this increased activity around M&A within the network as I think that's presenting enormous opportunity. And I just encourage everyone to have a look at the incredible amount of activity in wealth management generally, in the superannuation space and in the advice space, the incredible amount of capital being attracted to the market from offshore. It's for a reason. The fundamentals are right. And so I just see someone, Mike here has dropped something in. Let me see if I can get the essence of this question. New to the company, trying to define the essence of the business model based on memory. Yeah, I think so, Mike. I think Mike said, is this similar to he's new to the company, so are the services that WT is providing similar to what the picks and shovels or the services companies might provide in the resources space? Not dissimilar to it at all. We're definitely providing a broad range of services, but fundamental to it is this. If you compare it to resources, imagine that we're licensing the project as well. So, every advisor in the country needs to be attached to a financial services license. So we're providing that licensing. As such, we're responsible for the conduct of the advisors, which means that we're responsible to make sure that they're well trained and well up to speed with what all the requirements are. But you hit the nail on the head. We do share in the revenue with them. And so we're very motivated to help them. It's not like they're just renting space off us and renting services off us. We're really motivated to help them grow their businesses and their profitability.
Wonderful. Well, that is all we have time for today, Keith. If we've missed any of your questions, I encourage attendees to reach out via the contact details on our ASX releases, and then we can organise a meeting with Keith and the team. But thanks again, and we look forward to hosting you next time.
Thanks, Jane, and thanks everyone for joining us. Appreciate the opportunity.